The banks are getting rich. Well, better put, the banks are getting richer, and they're keeping homeowners poor.
Today we're going to watch this video with Clearvalue Tax about banks are enslaving homeowners with higher mortgage rates. And have you heard about the 40-year mortgage? Whew! We're going to hear what he has to say. He always has some really good insights. Let's dive in together. I'll chime in where I feel is relevant, but let's watch it together. Be sure to hit that subscribe button. Let's go.
But the situation is getting worse with higher mortgage interest rates. I'm going to show you exactly what is going on. So basically, the banks and lenders are financially enslaving new homeowners with higher mortgage interest rates. So today's video, it's a wake-up call for you. I'm going to show you something you might not like what you see. I just want you to know that you did nothing wrong. The most important thing that you can do right now is to understand the situation so that you can start building your wealth instead of making the banks and the lenders rich. Because they're getting rich and they're keeping everyday Americans poor. That's the reality. So let's run this scenario in a mortgage calculator.
I can tell you right now, this may surprise some of you, the numbers he's probably going to punch in.
Rates. The median sale price of a home in the US is about $400,000. So we're going to use that. First-time home buyers, they put down about 6%. Repeat buyers put down about 13%. So let's just use something in between, and we're going to go with 10%. The 30-year fixed mortgage interest rate has been floating around 6 to 7% for the past 7 months. So we're going to use 6.5% as the rate in this example. With these variables, your monthly mortgage payment would be $2,275. This does not include property taxes, homeowners insurance, PMI, or HOA fees. Now this is what I want to show you. It's the amortization table. This gives you a breakdown of how much of your payment goes towards interest and principal. Okay, so here it is. This is the Amort Table. Let's just say that your loan starts in May and your first mortgage payments begins in June. So look at your monthly mortgage payments. You are paying $2,275 and only $325 is going towards paying down the principal. $1,950 is for paying interest. So that's 85.7% of your payment for interest, making the banks and the lenders rich at your expense.
I mean, holy shnikes. So only about 15% of the monthly payment goes towards the actual principal, which is the actual money you pay for the home, meaning what, 85% of the money you pay on a monthly basis just goes towards paying interest, doesn't even actually go towards paying off the home. Wow.
So look for yourself. Every month, it doesn't get much better. Each month, the interest, well, take a look for yourself. It's only going down by $2 a month. But you know what's crazy, or what's even crazier? If you go 10 years into this loan, you're still paying interest of over $1,600 a month. So let me ask you, how?
That's 10 years in?
How old are you going to be in 10 years? How much older are you going to be in 10 years? Well, at that time, you're still going to be paying down this loan, and 73% of what you pay will still be going towards interest. Okay, so the banks and the lenders,
So after 10 years, 73% of your payment is still going towards interest. And did you notice what the total principal balance was? You still owed over $300,000 on a $400,000 home. God.
banks and the lenders, they love this. They love the situation. How could they not? They are enslaving people financially. That is the truth. So I want you to think about it like this. Okay, so you own a home and you should be proud. That's the American dream, right? But if you have a mortgage, are you truly the owner of your own home? And you could think about,
Think about that. That's really, really worth thinking about. Because even if you get that whole thing paid off, do you really own it? Because you still got to pay property taxes, don't you? And what happens if you don't pay your property taxes? Government takes back their house, their land. What a system.
And you could think about, you could respond by saying, hell yeah, of course I'm the owner of my own home. It's your home. Well, I would ask you, okay, well, what would happen if you stopped making the mortgage payments? How long would your home still stay yours if you stopped making those monthly payments? Now, if you have a mortgage on rental properties, that's different. You're using debt in a good way. You're getting someone else to pay off your loan for you and you're building equity. But if you...
That right there is a very good point. That's what the wealthy and rich do. They don't care about owning their own home. They own homes and they have someone else pay for them via rentals, etc. Because in my opinion, we're all really just renting anyways.
For you and you're building equity. But if you have a mortgage on your primary residence, then you basically have a landlord, which is your lender. So that interest, you saw the numbers for yourself. You saw the interest that you're paying on a monthly basis. That's basically you paying rent to your landlord, which is the institution that has claim to your home. Now, do you see how bad this situation is? Do you understand how bad the situation is with higher mortgage interest rates?
I try to explain this to people all the time because I didn't always know this, right? But when I did, it was like, holy crap, you can't unsee these type of things.
Is with higher mortgage interest rates. If you buy a $400,000 home and you put down 10%, that means that you're getting a loan for $360,000, right? With an interest rate of 6.5%, over the course of the loan, you will pay $459,492 in interest. The interest ends up being more than the loan itself. You borrowed $360,000, but you will end up paying back $819,492. This is what financial slavery looks like, and this is considering that you're lucky enough to buy a home. And honestly, I'll tell you this. What I showed you is a very generous example of the current situation because I didn't include all the other monthly expenses. So imagine that you add in the other monthly expenses. We're talking about property taxes, homeowners insurance, HOA fees. You can throw in PMI in there if you want. And your monthly payment, it could be over $3,000. And only $325 of that would be going towards paying down the loan. So those numbers, they're just ridiculous. So seriously, just think about that. Your monthly payments, it could be well over $3,000 and only $300 and change is going towards paying down the principal. Now, I want to show you how this compares to people that got mortgages or refinanced a few years ago when interest rates were at 3%. And I know that some people here that are watching have mortgages under even 3%. So all the variables are...
This is going to be really big, so pay attention.
Even 3%. So all the variables are the same, except now we're using a mortgage interest rate of 3.0% compared to 6.5%. And look at the difference. The monthly mortgage payment has fallen from $2,000.
Look at that difference. And when we boil it down to future payments, etc., interest paid, principal paid, etc., it's going to be even more shocking.
$2,275 to this, $1,517. That's $758 less a month simply because the interest rate is lower. And when you look at the Amort Table, it's just so much more reasonable. On a $1,517 mortgage payment, $617 is going towards paying down the loan. In this scenario,
so instead of only 15% of the monthly payment going towards principal, we're looking at more like 40% going towards principal.
Down the loan. In this scenario, $900 is for interest, and you can compare that to $1,950 a month. So I'll tell you this, a lot of people are waiting. A lot of people are eagerly awaiting for mortgage interest rates to fall so that they can refinance, and I don't blame them. But I'm telling you, if you compare 6.5% to 5.0%, it's better, but it's still bad. If you get to refinance at 5.0%, you're still paying $1,500 in interest a month. At 4.5%, the interest is $1,350 a month. At 4.0%, it's still $1,200 a month. Now, I want to say this. The purpose of this video is three things. The first thing is, it's to make you aware of the situation. So listen, the banks and the lenders, they're crushing everyday Americans. People are getting trapped, and the majority of people don't know it. They don't even know. So how are you supposed to help yourself if you are unaware of what they're doing to you? They're trapping you. So here's the second thing. The second thing I want to say is that do not confuse my message. I'm not saying don't get a mortgage. I'm not saying don't buy a home. I'm telling you that the banks and the lenders, they're trapping you, but you can get out of the trap. The quicker you pay down your mortgage, the less money that the banks and the lenders will make off you. They don't want you to make additional principal payments, and they don't want you to know what is going on. They don't want you to be educated.
That's really big what he just said right there. They don't want you to make extra principal payments. Listen to me. If you make extra principal payments, meaning that all the money that you pay above your minimum monthly mortgage payment goes directly towards principal, the savings that gives you over time is incredible. I don't know if we're watching this video together. I haven't watched it. I don't know if he's going to dive into that. I hope he does, because it is incredible, right? The savings it gives you over the life of the loan. Not to mention you actually pay the loan off faster, obviously, and you pay a lot less money. Like just paying an extra 5 or 10% a month could save you tens of, if not hundreds of thousands of dollars over the life of the loan.
They don't want you to know what is going on. They don't want you to be educated. They want you to be enslaved to them so that they can get rich at your expense. So in this scenario, $400,000 home, your loan is $360,000, mortgage interest rate of 6.5% on a 30-year fixed. If you pay an extra $100 a month, instead of paying off your loan in 30 years, it'll be cut down to 26 years. An extra $200 a month, you'll have it paid off in 24 years. An extra $500 a month, 19 years instead of 30. So I know that this is asking for a lot, but an extra $1,000 a month, you'll pay off your mortgage in 14 years instead of 30. So the third thing that I want to say is that if you have some...
He didn't say it there. He talked about how much faster you'd pay off the loan. But imagine if you're paying, what, $2,500 a month? That was the example at the 6.5%. I think it was $2,500. So you pay it off 3 years faster. So how much savings is that? I mean, that's, what, $2,500 a month times 12 months. That'd be $30,000. You'd be saving $90,000 over the life of the loan. That's better than putting your money in like your 401k. Or where else are you going to find where you can pay $100 a month for 27 years and turn it into $90,000? Do that math. $100 a month over 27 years is how much money? Well, that would be $1,200 a year, $12,000 every 10, $24,000 in 20. It'd be a little over $30,000. So you'd pay an extra $30,000 over the course of 27 years and save and turn it into $90,000. And my math is probably wrong. It's probably more like $120,000 because you're actually putting that money towards it that just goes straight back into equity anyways. Huh.
So the third thing that I want to say is that if you have some excess cash, here's what I would recommend that you do. So the first thing is that I would recommend that you build an emergency fund so that you don't have to dip into your savings, you don't have to liquidate your stocks, or you don't have to do an early withdrawal on a retirement plan. If you do have an emergency fund, so if you're still good there, then I wouldn't necessarily use your excess cash to pay down your mortgage, because you have to look at what debt has higher interest rates. If you have credit card debts, you're going to want to focus on paying down that debt first, because again, it'll typically have a higher interest rate. So that is what you should be focusing on. If you're good there, you have an emergency fund, you don't have credit card debts, In that situation, a lot of people will be asking what they should do with their excess cash. People typically ask, should I take my excess cash and invest it in the stock market, or should I pay down my home? And the answer is that it depends. It depends on what is your mortgage interest rate. If your mortgage interest rate is 3%, if it's 3%, then I would stick your excess cash into an index fund in the stock market. You can easily beat 3% in the long run. If your mortgage interest rate is 6 to 7%, then I would say that you should really consider using any extra money to pay down your home. Because if you pay down your home and you have a mortgage interest rate at 6 to 7%, that would be like you getting a return on your investments of 9 to 10% pre-tax, which is, that's pretty hard to beat. And I already gave you the numbers, how much more quickly that you will have your mortgage paid off. If you're a crypto investor, I know the mentality. I know that you want to get rich or die trying. I understand. I know that what I'm telling you seems like the safe thing to do. In other words, it sounds super boring. And I understand that a lot of crypto investors would just rather YOLO it. But to all crypto investors, just consider what I'm saying, with a portion of your money at least, to take a balanced approach. I'm not trying to ruin all the fun for you, but just
balance is important. We don't have to do all or nothing. We can split things up.
Ruin all the fun for you, but just think about it with a portion of your money. Fair enough? And I know that some people will say this. They're going to make this argument. They're going to say that with my mortgage interest payments, you're getting an itemized deduction. So all this interest that you're paying to the banks and lenders, it's not all that bad. So all this interest, they would make the argument that it's being used to lower your taxes. Have you thought of that, Brian? A lot of people ask me that. Let me tell you something. When you're using mortgage interest as an itemized deduction, then you're probably deducting your taxes paid as well. Probably the max amount, because it's limited. They capped it off. So the combination of the two is most likely making you subject to AMT. That's the alternative minimum tax. So even though mortgage interest is not affected by AMT, it's triggering it somewhere else, and you're not getting the full tax benefit of all that interest that you're paying to the banks. So did you think of that? So probably not, maybe you should. Okay, I'm gonna end with this. Higher mortgage interest rates, or higher interest rates in general, they're terrible if you're a new homeowner, if you're getting a mortgage. And I want to encourage you to do something about it. Do not be trapped for 30 years, especially if you have a high mortgage interest rate. You've witnessed the numbers for yourself. Get yourself free. Get yourself free as soon as possible. I don't want you to be a financial slave. That's all I'm saying. I'm just trying to help you. I want to see you achieve financial freedom. Do it for your family. Do it for yourself. Do it for justice, because this is not right. So I hope this was helpful. Please.
That was a really powerful video. Just some good, basic, valuable education. That's why I like Clearvalue Tax. He's got a pretty nonsensical approach to things. He's an educated guy. He's an experienced guy. I like watching him. He gives a good balance. Now, we don't necessarily agree on everything or have the same philosophies on everything, rather. But he's a good resource, and we'll be doing more of these watch together videos also. Hit that subscribe button. Thank you for watching. Hopefully I was able to add a little bit of value to this video. Take care.